Good afternoon, everyone. My name is Katie Bruno, and I am a certified financial planner and financial advisor at Maureen Quinn Wealth Partners. Today, I am hosting a webinar all about tackling the college savings problem. I wanted to talk about saving for college in honor of 529 Day. 529 Day is May 29th, which is a Sunday this year. And I wanted to highlight the importance of having a plan in paying for college. So for those of you who aren't familiar with 529s, 529s are a type of investment account that is designed to help people save for college. And we're going to talk about that later on in this webinar. We're also going to talk about the current cost of college and the future projections for college costs. I'll then delve into some different saving strategies available to you to help save for college. And then I'll talk about balancing your financial goals. A lot of people who are wanting to save for their kids or even grandkids' college are also saving for their own retirement. And so I'll talk a little bit about how do we balance these different financial goals. And then if you are in the state of Nebraska, there is a new program called the Meadowlark Savings Pledge for Nebraskans that I'm briefly going to highlight because it was released in 2020. And then I'll go over some different planning opportunities and give you some takeaways that you can immediately put into action in your own financial plan. So let's talk about the cost of college. So we know that the cost of college has continued to go up. Just looking back from 2010 to 2011, and then fast forwarding 20 years, the cost of a public four-year college in state has gone up by 15%. And the cost for a private four-year college for a private school has gone up 17%. And you'll see on the left side that this is in 2020 dollars, and it was adjusted for inflation. Now, I know with what's going on in the current economy that inflation is at a much higher rate, but this is going back adjusting for inflation over those 10 years from 2010 to 2020. So keeping on with this inflation, if we assume that a four-year college inflates at a rate of 5% every year, that puts us at 2037 for it costing 4 years, $230,000 for a public in-state college degree. For a private four-year degree, we're looking at a total of $536,629 for 4 years. So what we know is that college costs are going to continue to rise. And while these numbers are scary, there are a number of steps that we can take to tackle this head on. And it's really important for you to know your options when it comes to saving for these costs. My goal as a financial advisor is to help steer you towards developing a plan and providing key information when it comes to saving for college. Now, I also want to point out that these numbers will go up quite a bit when you add room and board. So a lot of people start to ask the question, well, if college is so expensive, do you even need a college education today? Are people with college degrees really making more money than people who do not have a college degree? And the answer to that is statistically yes. On average, someone with a bachelor's degree will make $750,000 more over their lifetime than someone with just a high school diploma. And this study here was looking at earnings in 2019 and people who worked from the ages of 25 to 64, so adding up what they made over their lifetime. And you can see the money that you make, the average earnings that you make over your lifetime goes up considerably when you get to doctoral and professional degrees. But along with the rising cost of college, we're also seeing a lot more debt being taken out to pay for college. So we know that the student loans across the United States have continued to grow. And actually they have grown at a rate of 324%. This is 4 times faster than the cost of college. So student loans are growing at 4 times faster than even the cost of college. And that's because a lot of people have to take out student loans to pay for more than just their loan. They have to take out student loans to put food on the table, pay for their car insurance, pay for cell phones, things like that. And so if you look at the chart on the right for debt balances from 2005 to 2021, you can see that the student loans, while still in 2005, not as high as auto loans, credit cards, or home equity lines of credit, HELOC, if you go fast forward to 2021, student loans have surpassed auto loans, credit cards, and HELOCs. And the average outstanding college loan balances, so these are at the end of 2021, the average outstanding college loan balance for a parent to finance their kids' loans was $28,600, and the average loan for a student was $25,100. So when we don't invest, when we don't save ahead, when we don't make a plan, we typically have no other choice but to borrow and take out a student loan. But people who have student loans have said that having their loans affects their ability to meet their other financial goals or save for their other financial goals. And we know that when you have a student loan, that you go into the workforce and you're carrying a large amount of debt, and you have to make this other monthly obligation, which affects your ability to pay and fund other things. And so this was a survey done by JP Morgan Asset Management in 2020. And it asked people what their student loan payments have affected their ability to do. And parents have said that student loan payments have affected their ability to pay for their own or invest for their own child's education. So 87% of people said that their own student loans were affecting their ability to start saving for their child's education. And I'll just go down to the third one. 62% of people have said that their student loan payments affect their ability to save for their own retirement. Another statistic here is that 2 in 5 families have to borrow more than $50,000 for college, which is a lot of money. So, but there are people who are saving for college, and we know that when you save and make a plan for college, you historically end up having to pay less, because when you invest, you get some earnings. So this chart here says that for those people who are saving for college, 42% of people are saving, families are saving for college using cash. There's $437 billion sitting out there for people who are saving using cost. Or sorry, saving using cash, I apologize. And 39% of families are saving using 529 education plans. So families often do not choose savings or investment vehicles that maximize their growth potential. These options, such as savings accounts, CDs, they're not always the best option because you're not earning a huge rate of return, and therefore you're going to have to put more money away to save for college. So the sooner you start investing, the less it's going to cost. And the key here is the sooner you start investing, the less it's going to cost. If you go to a cash option, you're usually not going to get enough rate of return to do much in the long term towards college. Usually those cash options won't even grow enough to keep up with the inflation that is happening for the cost of college. So this chart just showed you 3 different scenarios. One starting at birth, the middle one is starting at age 6, and the third one is starting at age 12. And we have 3 different savers, one who's putting away $100 a month, one who's putting away $250 a month, and one who's putting away $500 a month. And you can see if you start at birth and put away $100 a month, by the time the kid gets to age 18, and this assumes a 6% rate of return on your investment, you've got $38,281 put away for college. If you were putting in $250 a month, we're talking around $95,000. And if you put in $500 a month, you're looking at $191,000 put away, saved for college. And you compare that to starting at age 6. First, the investor who starts at age 6 and puts $500 a month in, that's $104,000 over those next 12 years, which is a difference of $87,000. $87,000 over the entire college savings goal. But even starting at age 12, you still put $100 a month starting at age 12. That's 6 more years until you go to college. You've got almost $9,000 there. So what are your different options? There are several different ways to save for college. There is college savings plans, 529 plans, a custodial accounts, UDMA, UTMA, and then there's a Coverdale savings education account. I'm going to talk more in detail about 529 plans on the next slide, so I'm not going to spend a lot of time talking about it on this page because I'm going to really get into the details. Most people who are saving for college and investing, 42% of the ones who are using some sort of investment option are using 529 plans. But 529 plans are called 529 plans because the IRS section that talks about 529 plans is IRS code 529. And so that's why we call them 529 plans. In a 529 plan, this is a type of college savings account that lets you put away for college as a parent, a grandparent, an aunt and uncle. So there is really no restriction on who can be the person owning the account and putting away the money for a child, what we call the beneficiary, to go to college. And it allows you to put money into the account, which grows or invests, and you don't pay taxes on the earnings. And then if you use the money for a qualified education expense, you do not pay taxes on the withdrawals. If you do not use the money for an education expense, you typically will pay tax on the earnings plus a 10% penalty. And I'll talk more about that on the next slide. So in comparison to a custodial account, so a custodial account is also an investment account for a child, but the funds don't have to be used for college. So a lot of families that I work with will say, well, what if Jimmy or Susie doesn't go to college? I don't want that to get penalized on my money if they don't go to college. And so they'll be interested in opening a custodial account because their money doesn't have to be used for college. One of the main things I want to point out on a custodial account is that these are for the child and they are the minor's account when that person reaches the age of majority. So if you open one of these for your son or daughter, and when they reach the age of majority in your state, which is usually 18 or 21, then the child will assume control of that money and you will no longer have control on that money. So if you do not think your child is going to be mature enough to handle the amount of money that you have saved for them at that age, custodial accounts are not always the best option because you will lose control at that point. Also, if the money is designed to be used for college, then when it comes to getting financial aid from both the U.S. Department of Education and at the university level, these types of accounts do have a higher impact on financial aid eligibility. The way that financial aid works is the FAFSA, which is the free application for federal student aid, is filled out each year by anyone who goes to college. And the FAFSA number calculates what's called an EFC, expected family contribution, which is what they expect each family to contribute. And if assets or income is in the student's name or the minor's name, it typically has a higher impact on the EFC. If the assets and the income are in the parent's name, it typically has a lower impact on that EFC. And I'll talk a little bit more about that later. So keeping in mind that the child, if the child has a custodial account, then these assets are considered theirs and they have a higher impact on that federal student aid number. And the last type of account I'm going to talk about is the Coverdale Education Savings Account. So this is a education savings account. So similar to the 529 plan where it's used to support education, but the key here is it can be used at any level of education. So not just college. So a lot of families who will use the Coverdale Education Savings Account may be putting money away for their children to go to private school for K through 12. With a Coverdale Education Savings Account, you are limited to how much you can put in. You can only put up to $2,000 annually per beneficiary. So if you have 3 kids, you put in $2,000 to each child account. So that's $6,000 total, but that's the most that you can put in any one year. The contributions have to be put into the account before a child turns 18, and the assets have to be used by age 30. You are able to invest them. And the last thing I'll say on this is there are income limits on who can put into these. If you make over a certain amount of money each year, then you cannot put into this, similar to those requirements of a Roth IRA. So let's talk a little bit more about 529s. So like I said, they are a tax advantaged account that's meant to be used for education expenses. The beneficiary is the person for whom a 529 account is opened for. So as an investor, you can open an account for your child, your grandchild, your friend. You could even open an account for yourself because there are no age limits. The requirement is that the beneficiary has to be a US citizen or have a valid Social Security number. These accounts can be opened by almost anyone. There are no income limits, and anyone can contribute to a 529 plan. And then when you go to use this money, you're going to use it to pay for qualified higher education expenses, and those expenses at most colleges and universities and even technical trade vocational schools will be tuition fees, room board, book supplies, computers. And then there are some 529 plans, and this was some legislation that was passed in 2020 under the Secure Act that allows 529 plans to be used for K through 12 tuition and also education loan payments. But it's important that you check with your plan to see if that specific plan will allow you to pay for those items, because at the federal level, it works, but at the state level, you still could be taxed. So the other advantages of 529 plans are if your beneficiary does not go to college, Jimmy or Susie gets to be 18 years old and decides they're not going to college, or maybe they are going to college, but they have been given scholarship and they no longer need the money that you have put away. You can change beneficiaries or transfer the money that you have within your 529 plan to another family member. You, as the account owner, the person who opened this account, you have full control over the assets. So if they don't go to college, you do not have to give them this money. You can change the beneficiary. If they do go to college, but they don't need the money, you can change the beneficiary, or you can end up taking that money out. You would pay a tax on the earnings and potentially a 10% penalty, but you still have control over that money. You do not have to give it to the beneficiary for whom you open the account. There are limits on how much can be contributed to this plan, but they're very high contribution limits. So in comparison to the Coverdale Education Savings Account, where you can only put in $2,000 a year, the contribution limits for a 529 plan are as high as $400,000 per beneficiary. Oftentimes we see our clients and families use 529s as an estate planning tool. With these accounts, any money that you would put into a 529 plan would be removed from your estate, your taxable estate. So for those who are looking at paying very high estate taxes, they may gift a lump sum of money to a 529 plan to remove that money from being taxed at the estate tax rate. And the most that you could put in a single year would be $160,000 per beneficiary from a couple, or $80,000 from an individual. And in some states, the contribution to a 529 is tax deductible from the state level. And Nebraska is one of those states. So if you are a Nebraska resident and you file a state tax return in the state of Nebraska, and you put into a Nebraska 529 plan, you do get a tax deduction at the state income tax level for doing that. And there are several different states that have tax deductible plans. It's usually sponsored by a plan for that specific state that you would have to open their 529 plan, contribute to their 529 plan to get that state tax benefit. Now, it's important that you look and see what options are available in your state before you open a 529 plan, just to make sure that you get to take advantage of those benefits available to you. And before I move on, I'll just briefly say that those tax benefits are usually limited to a certain dollar amount. So in the state of Nebraska, you get a state tax deduction on a contribution of up to $10,000 per year. And that's $10,000 per year in total, not $10,000 per beneficiary. So $10,000 per year. So if you have 2 kids and you put in $5,000 to each one, you get that state tax deduction. If you put in $6,000 to each one, you still only get the tax deduction for the first $10,000, not that full $12,000. So moving on, I want to talk a little bit about, I want to pivot and I want to talk about balancing your financial goals. So a lot of times saving for college and saving for retirement are competing interests, because parents want to save for their kids' college and feel a strong obligation to do so, but they also need to save for their own retirement. And these two goals are very intersected on your timeline, especially if you had kids as an older adult. But I want to say here that you don't get to borrow to pay for your retirement the way you can borrow for college. And while I don't want to advocate to have your plan be borrowing or taking out student loans, I do want to say that you can't borrow for your own retirement. So it's really important that you remember that as you're building your whole financial plan. I want to also talk about that Fafsa again. When I was talking about the Fafsa and how they calculate what's called an expected family contribution, EFC, retirement assets do not count against you on the Fafsa for financial aid. They don't even get reported. When parents are saving for their retirement, the Department of Education assumes that money is earmarked for retirement, and they don't ask you to even list that as a asset on the FAFSA. So 0% of retirement assets are listed. Now, some people will use retirement accounts to pay for college. And the thing to remember here is that once you start withdrawing from a retirement account, that money is counted as income. And that's when it does get reported on the FAFSA. Income on the FAFSA for the parent is reported at 50%. So 50% of your withdrawals from a retirement account for college would count against you on the federal aid form. So I just want to briefly talk about this chart in the middle. It says how college withdrawals can jeopardize retirement. So assuming that you're going to withdraw the amount in blue, 10,000, 25,000, or 50,000 for college, and that your money is earning that rate of 6%, and that you still have 20 more years until you're going to retire. So a $10,000 withdrawal for college over the next 20 years is $32,071 that you've actually taken from your own retirement. $50,000, you take out $50,000 for college out of your retirement account over the next 20 years, assuming that had 6% return, that actually jeopardized you by $160,357. And again, this is just talking about the investment potential that could have happened up to your retirement. It's not putting in any calculations for taxes on that amount withdrawn, or the potential penalty that could be there because you're not using that money for at 59 and a half or older. So there was a study done by T. Rowe Price on parents. It's called Kids and Money Survey, and this is the 2022 will be the 13th year that T. Rowe Price has done this, but the statistics that you're seeing on the screen are from 2021. And T. Rowe Price interviewed or surveyed about 2,000 parents, both men and women, of children ages 8 to 14. And they had asked them, which of the following do you have? And 59% of the individuals surveyed had money saved for retirement. 43% had money saved for kids' college education. When these same set of parents were asked how important it was to discuss the following with your child, 76% said it was important to discuss saving for college. So I want that to sink in. 43% had money saved for kids at college. 76% said it was important to save for college. And then these same parents were asked how often were they discussing the following with their child. And they had said 54% were actually discussing. So while 76% thought it was important, only 54% were actually having the discussion. And you can see down at the bottom where it says never, rarely, occasionally, frequently, always. Of those that were discussing it, only 27% were frequently and 27% were always discussing it. So this is a conversation that is extremely important for families to have. It's really important that you have a realistic discussion about your overall finances and what's important. If you have to prioritize goals, if you as a parent cannot save for your own retirement and college, I, as a financial advisor, would tell you to put your retirement first. But it's important that you have that conversation with your kid and set realistic expectations so that they can also plan, because no kid wants to graduate from college with $200,000 in student loans and then have to make a plan to pay those back. And you also don't want to be taking out a ton of student loans for your child and then having to pay those back in your retirement or delaying your retirement to be able to do that. So it's having those conversations, it's talking about what college costs and what the different options are for your child. If it's important that they go to a four-year, to a public or private university and get that four-year college degree, talking about different scholarship opportunities that are out there, different ways that they can save ahead for college now, maybe through having that summer job or looking at other opportunities for when they go to college to get some money to help pay for it. So it's just important that these conversations are had and that it doesn't get left on the table and be one of those things that you talk about when things aren't the way you had wanted or planned for them to be. So I want to briefly talk about the Meadowlark Savings Pledge for Nebraskans. So the Meadowlark Savings Pledge for Nebraskans, the Department of Education in the state of Nebraska and the Treasury started this to help encourage Nebraskans to save for college. So the pledge is that any baby born after January 1st, 2020, who was a resident of Nebraska at the time of birth, will receive a one-time contribution of $50. Babies are automatically enrolled in the program in the spring following their year of birth. So any baby who was born in 2020 was enrolled in 2021 in the past few months. And this is an automatic thing. It costs nothing and there are no paperwork required of you. When you're at the hospital having your baby, you get automatically enrolled into this program. And when you do your paperwork to get your social security card and birth certificate and all the other things that the hospital helps you through, they enroll you into this. And I believe there is an option at that point to opt out if you don't want to be in the plan. But the important thing is here, it's $50 and it's just a seed to get you started. It's not enough to pay for college in any means, and it is invested, but it's in a very conservative investment option. So it's not going to grow to be a lot, but it is something from the state to get you started. And it's their way of encouraging you to go out and open your own 529 plan through the NEST, which is the Nebraska Educational Savings Plan Trust. That is the name of the Nebraska 529 Savings Plan sponsor. So if you do have your own NEST account and you do go out and open your own account, you will see the $50 from the state on your quarterly account statements. You can't touch it. It's just there to get you started. And then you can look up more information on this on the Nest 529 website that I've listed here. So let's talk about just a few of the things that I already talked about, but want to reiterate, and then some different planning opportunities that you can implement into your plan or talk to your financial advisor about, or reach out to me. I'd be more than happy to have a conversation about how we can incorporate college savings into your overall financial plan. So remember, many 529 plans offer state tax benefits in addition to that tax-free investment. So check out your state. Like I said, in the state of Nebraska, they have one. The state of Iowa has one. There are several 529 plans across several different states that offer some kind of tax deduction for contributing. 529s are a great tool for saving for college because they can be transferred among family members. A lot of times, if you have one kid that doesn't go to school or doesn't need the money, then you can reallocate those funds that you've invested for another family member. Whoever opens the account, I put parents retain control of the account if they're in their name, but whoever opens the account has control of the money. So you're not, just because you open a 529 account for your child or grandchild, doesn't mean that you've given up control of that money. I would encourage your family members, grandparents, aunts, uncles, friends, people who give gifts to your children at the holidays or for their birthdays to make a college savings gift instead. All 529 gifts and investment gains are removed from the contributor's taxable estate. So it can be used as a estate planning tool if you are subject to estate taxes. Something to keep in mind, student loans for graduate school may have higher interest rates than undergrad. So again, this goes back to that conversation that I'm encouraging you to have with your children. If graduate school is something that you are strongly encouraging and would like your child to do, remember that the student loans usually have higher interest rates. So if you have to help with undergrad or graduate, you may consider taking out student loans for undergrad and helping pay for graduate, just because those are higher interest rates. And also, if you have the ability to start investing now and saving for both, that's always going to be the best option. Some families want to use 529s to pay for K through 12 private education because that is now available in some states. But just keep in mind that this may limit the funds available for college. So that compound interest and having the time for that money to work for you, if you have to use that in the early years to pay for private education, you're not going to have as much money available to you for college. Completing the Fafsa, it's important that you do complete the Fafsa, and the Fafsa can be filed as early as October of the senior year. I work with a lot of families who will tell me that they don't know why they need to file the Fafsa because they know that they're not going to get any help from the Department of Education. And I want you to know that it's not just the Department of Education. The colleges will also use the Fafsa form to determine who can get aid at the college level. So if your kid is going to go to a private university, this FAFSA can be extremely critical in helping this private university give your child a scholarship or a grant that they have available. So it's not just used by the Department of Treasury to get government student loans. So please keep that in mind. UGMA and UTMA, so these are the custodial accounts that we talked about, they count as more of a contribution for the student on the FAFSA, and they also become the student's money or in the student's control possession at the age of majority in your state. Consider planning for college, retirement, and other goals in a holistic, comprehensive manner. We want not just college to be saved for, not just your retirement to be saved for, but having all of these things working together so that you can make the biggest impact for your family. So if you're not currently saving, consider starting now. It's never too late. There's always something. Even if you can only put away $100 a month or $75 a month, it's something that you can start saving and investing that can grow for you now. If you are currently saving, do a review on how much you are saving and determine if you can increase that savings or if you need to increase that savings to meet that goal. Review your investment mix. So most 529 plans have what's called age-based investment options. So the way that these work is as your student or your beneficiary gets closer to college, the investment mix becomes a little bit more conservative to limit losses that would be due to the market in years right before they go to college. So they get more conservative just so that they have less volatility, because the closer you get to you needing the money, the less time you have to make up any losses from market volatility. Discuss your family's goals, discuss your family's philosophy in helping with the cost of college and the impact it's going to have on your other financial goals. Again, have that conversation at the dinner table. Have that conversation between you and your spouse. What is the philosophy on helping with the cost of college, and how, if you do help, might that impact your other goals, such as retirement? And then start talking with your kids about money. It's never too early to start having these conversations. It may not make sense to talk with your 4-year-old about the cost of college, but you can talk about money and different financial decisions that you make in your household. And I have a great webinar out there on talking to your kids about money. If you're looking for ideas, just check that out on my YouTube page. So as your child gets older, though, include your student in conversations about the actual cost of college and different financial conversations that can impact their college decisions. Anyway, I know this was a quick webinar and there was a lot of information covered. So if you do have any questions on anything that we talked about, or want to further discuss how you can start saving for your child or grandchild's college, please don't hesitate to reach out to me. I'm available and I'm here to answer any questions that you may have. I want to thank all of you for listening today, and I hope that in honor of 529 Day, you are able to do at least one thing that I talked about in this webinar, whether that's having that conversation with your child, or going out and setting up a 529 plan, or sitting down and just putting on paper what might be a reasonable amount of money for you to put away for your child or grandchild's college education. So again, thank you all, and I hope you have a great Memorial Day weekend.